Hey folks, welcome back to Honey Money SG. Now, this very important question: should you use your cash or CPF to pay for your housing loan? And the reason why a lot of people actually ask this question is because they try to weigh the importance between having cash on hand that you can use to do other things like investing in stocks, or you want to invest in your business, or rather you can actually cash out your CPF to go and buy your own property. Because as a lot of you know, CPF is actually untouchable until you reach the age of 55 and you have achieved your full retirement sum. Then you are eligible to withdraw the amounts. So there are definitely two sides of this camp. Whether you support the use of cash or CPF to pay, I think you have to understand this very important concept called accrued interest. With that, let me bring you to a very short discussion on what I talked about accrued interest in a previous video. Let's talk a bit about accrued interest, right? Because a lot of people have misconception about that. Why the need to pay accrued interest if they borrow from their own CPF account? Now, CPF accrued interest is actually kind of the interesting mechanism. You see, the government expects you to actually keep your CPF and not use it for housing. That way, it can help you generate 2.5% annual interest on your OA. But one day, the government suddenly allowed you to use your CPF OA for housing, and that's what a lot of people did, taking out OA funds to go and purchase their property. And then, government has to introduce this thing called accrued interest. That means whatever funds you have taken out from the OA, you have to pay it back up with the interest that is supposed to earn you if you actually leave it in the CPF OA account. That means a 2.5% interest annually compounded. Once you actually sell away your flat, you have to pay back to the accrued interest. Now, you don't pay this accrued interest to the government, you are just paying back to your account. So let's clear the misconception, right? You're paying it to your own CPF account. And should you actually use your CPF OA to buy the next flat, then you will just pay it from the same CPF OA account that you just deposited, right? It's your own account. You take your own money. It's really pay back to your own money, what? So a lot of people have this misconception that accrued interest is really evil. I think that you don't really have to worry for accrued interest because you don't even have to pay for accrued interest if you sold it below the market value, you see.
But what if the sale proceeds from my flat is lower than the amount I need to refund?
Don't worry, you won't need to refund the shortfall in cash as long as the property is sold at or above current market value.
But CPF is our money, what? Why must pay back in the first place? Someone must return interest.
Because when you use your CPF to buy a flat, you are actually using savings that are meant to support your retirement. If you had not used that money, it would have continued earning interest in your account. And she's right, you can still use it to buy your next home.
Now I understand. Thanks,
But if you really want to avoid all these accrued interest thing, just don't use CPF to pay for your housing lah. Just use full cash. I think it's also good for people who don't do any investments because your CPF OA can help you guarantee a 2.5% annual interest. Whereas if you don't go for any investments and you put in bank, maybe you get less than 1%. So might as well just use the cash to go and pay for your property. Then your CPF OA, just keep it there, earn the 2.5% interest every year. Alright folks, welcome back. So you can see this is actually the explanation of accrued interest. A lot of people actually have misconceptions about it, but I hope that it gives you a better understanding of what it is about. So regarding the two camps of using cash or CPF to pay for your housing mortgage, right? I think let's start with the first one. When should you use your CPF? For people who use CPF in their housing, most likely you have a really low cash balance or you have very little cash flows. That's why you want to tap into your CPF account to help you finance your house, because your house for your own stay is essentially a very necessity spending. And if you don't even have cash, then at least a CPF can help you finance part of the burden so that you don't have to borrow too much money from the bank and incur an even higher interest rate. Now, the other argument for using your CPF is that you can actually use your cash on hand to generate better returns on your investment or investing in your business, right? We are talking about index funds investing. I mean, generally in a good market environment, you can expect up to 7 to 8% returns per annum on your index funds, which is significantly higher than what the CPF offers, right? The CPF OA only gives you 2.5%, while the special account only gives you 4%. And also, I felt that you should be using the 4% annual interest on your special account to do a CPF comparison instead of the 2% from OA. And the reason is because if you are not using your cash to finance your mortgage, then you can actually pump this cash into the retirement sum top up to your special account. And that is also eligible for tax relief, right? So that is a big assumption that your investing can generate better than 4% annual returns, which is quite impressive considering this bear market sentiment. So when should you actually use cash to finance your property? I felt that it's more suitable for people who do not actually do any kind of investments, because if they were not using any cash to invest, then at least they can use the cash to go and pay down their mortgage. Because you're not using your CPF, which means your CPF can be stayed there to compound in your OA at 2.5% and in your SA at 4%. And like I mentioned earlier, if you are not using your CPF, you can actually transfer all your ordinary account to your special account because you have no longer use for it, thereby bumping up your CPF OA from 2.5% to 4% in the SA. Now, the other group of people who should use the cash to finance the property is people who are uncomfortable with accrued interest. Like I explained, accrued interest earlier is just paying to your own CPF account, but some people just do not like the idea, right? They rather prefer the government to pay them interest on their CPF balances than they themselves generate outstanding returns from the stock market and then paying back to the accrued interest. And the last group of people who should use cash to finance their property are people who tend to use third-party payment processors like CardUp, where you can actually pay your mortgage using your credit card at a transaction fee of around 2%. The reason for using third-party payment processors is that some of these credit cards actually give you cashback and is eligible for CardUp, right? So I think there is a net positive gain if you were to use the third-party payment processor. Of course, you have to check the terms and conditions, whether it's worth it for your time and effort in using such services. So all in all, there's really no right or wrong in using either. I think if you were in certain situations, CPF will suit you better, and if you were in the other situation like I mentioned, then maybe cash suits you better. Ultimately, financing your property is one of your most important life decisions, so be sure to discuss with your partner and come to an aligned decision. So what happens to my own plan of financing my property? Will I use a cash or CPF to buy my own property? Now, if I were to use CPF to finance my property, I actually have less of such funds to go and invest through robo-advisors like Endowus and MoneyOwl, right? You know that I do purchase some funds with them, namely the S&P 500 and the Dimensional World Index Fund. So if I were to use the CPF to pay for the property, I wouldn't have such funds to go and invest anymore. But of course, there are much more opportunities that you could invest with cash than CPF, so that is also a consideration. Also, the existence of third-party payment processors like CardUp, as of now, is still quite rewarding to go through such payment processes, but in the future we don't know, right? Credit cards may actually cut this benefit and they may exclude CardUp as an eligible transaction in the future. Nobody really knows. So as of current state, I'm still quite undecided, but come till the day where my flat is finally completed, which is around 2 years wait from now, then maybe I may make a final decision on whether I would use cash or CPF and tell you guys through this channel, right? So I hope that this video has helped you decide better which one to go for, cash or CPF, to finance your property, and also gave you a better understanding of the accrued interest. But if you want to learn more about these CPF strategies and CPF hacks, then I refer you to watch my CPF and retirement planning videos here. With that, thank you for watching. My name is Christopher. This is Honey Money SG, steering young adults to financial independence.